CEO of BCE, joining us now, Mirko Bibic. And of course, BCE is the parent of BNN Bloomberg, where I've been happy to work for 24 years. Thank you very much indeed for joining us, Mirko. Really appreciate it.
Oh, it's my pleasure, Andrew. Thank you for having me.
You're bringing down the dividend by 56%. November, when you announced your big fiber investment in the States, at that stage you said, we're planning to keep it unchanged. But things have changed since then. What has got worse? What has changed that prompted this decision to cut the dividend?
Well, there's been a lot of developments since the fall of 2024, and basically the macroeconomic environment has changed, and that's had an impact on consumer confidence. The regulatory environment doesn't provide any more stability in terms of supporting investments. So, I mean, those are some of the key elements that have created a shift. But if you then move forward to February of this year, when we released our fourth quarter results, we did provide a capital allocation roadmap to investors that we said was going to guide us through this year and beyond, and we provided some pretty material updates to that roadmap today, and the roadmap, the capital allocation strategy, is really around strengthening our healthy balance sheet, investing for growth, and obviously with the objective of driving total shareholder return. So we provided some pretty material updates on those three pillars today.
Moody's, of course, as you know, this is quite a while ago, cut the rating to just one above junk. S&P didn't make a similar move. You're higher at S&P. But you've done various maneuvers. You bought back some debt. You issued hybrid equity since then. But what are your plans for debt reduction? Do you see debt coming down substantially in the next year, for example?
Right. So again, on the capital allocation roadmap, Andrew, so we got strengthening the balance sheet, and really the objective there is to accelerate deleveraging, number one, and optimize the cost of capital, number two. And on on deleveraging, what we outlined today is, as you mentioned, we opportunistically tapped into the hybrid debt markets earlier in the quarter. That would be one. The reset of the dividend will provide a significant cash flow to delever, and of course we've got two processes underway to divest of non-core assets, and the proceeds from those will go down to will be applied towards deleveraging. So I indicated today to the investor base that our goal is to get to 3.5 times leverage ratio by 2027, and then march on towards our target policy ratio of 3.0 by or before 2030. And the other element of big pillar of strengthening the balance sheet was optimizing the cost of capital. And there, what we did is we announced this morning that we were eliminating the discount on our dividend reinvestment program. Mm-hmm. And of course, the very exciting and material development in the U.S., our partnership with PSP Investments, which will basically provide a very attractive cost of capital to drive further growth for the BCE franchise and the Ziply Fiber franchise, of course, in the United States.
Now, that's a fascinating deal. Public Sector Pension Investment Board, I think they're putting in something like $1.8 billion here into the fiber venture. What are they buying here? I mean, first, do you get cash as part of this?
No, so what we're doing is we announced back in November that we were buying Ziply Fiber. Mm-hmm. Bell BCE will own Ziply Fiber in its entirety at closing. So the Ziply Fiber that exists today at closing will be owned by PSP. No one else will own any part of Ziply Fiber. What the partnership relates to is a venture, 51% PSP Investments and 49% BCE, and it's to fund growth in the United States. So we'll be using that joint venture to build last mile fiber to additional fiber locations, which will be, and we'll have the ability, we'll drive, we'll build to 6 million, potentially up to 6 million additional fiber locations from where Ziply Fiber is today. So that will provide significant subscriber revenue and EBITDA growth potential for Ziply Fiber at an attractive cost of capital. And what it does, of course, it improves the free cash flow profile of BCE by $1 billion, more than $1 billion actually, in 26, 27, 28, because now we've got a partner to help fund the fiber location development in the U.S. along with us. But Ziply Fiber will remain entirely owned by BCE.
Okay. Let's look at a 5-year for the stock. Of course, it's been tough. It's been tough in a lot of telecom companies. Rogers is down more in 5 years. But a total loss, even including dividends, of something like 25% in total over 5 years. Is there anything you should have done differently? For example, did you hang on to the high dividend too long?
Well, we are where we are, and again, in February we said we're going to provide a crystal clear capital allocation roadmap. We've done that. We've made some significant announcements today that really go towards strengthening the balance sheet. We do now have, with the dividend reset, the flexibility along with deleveraging to invest in key growth areas. And our key growth areas, I've been very consistent in outlining them, are, we're going to make investments to significantly improve the customer experience. Better customer experience leads to more subscribers, leads to more profitability. So that's one. Two, the second priority, of course, is fiber internet and 5G wireless, and the Ziply Fiber initiative is a significant component of the fiber internet growth. The third element is to provide a full suite of enterprise solutions. So in the enterprise segment, really driving growth by offering enterprises technology solutions. And the fourth pillar pertains to Bell Media, and it's to become and continue to drive forward on being a digital media and content powerhouse. And Bell Media had an outstanding Q1.
Yep, we were glad to see that. All right. Just to harp on about the dividend, Veritas claimed it was irresponsible to raise the dividend at a 5.3% annual rate over 5 years, while adjusted EBITDA grew at only 1%. Were you too stubborn? I mean, I know you had to agonize, people were in the stock for the dividend, but were you too stubborn about cutting it?
Look, we're looking forward, and now we've got the right plan in place. We've got the right capital allocation strategy. It's been well received today. We're going to accelerate deleveraging through the actions we've undertaken today, and we're going to invest in growth, and we're going to execute with extreme discipline and focus on those growth strategies, and we're going to deliver the returns that shareholders expect of us, and we're in a great position to do so.
Just finally, one analyst indicating that competitive pressure in the wireless business has been easing a bit. Of course, Quebecor still making waves as a fourth carrier. Is that your feeling, that the price cuts have been easing off a bit lately?
Yeah, so I thought that would be the case at the beginning of this year, and for a little short period of time it appeared to be the case, and then near the back half of Q1 it continued to be quite frothy and competitively intense. I think we're seeing more stability in Q2. So far in Q2, like we're halfway through, we're seeing price stability. We're seeing improvements in the rate of decline in ARPU, the average revenue per user. We're seeing improvements in churn. So it is looking better as I look out to the rest of the year.
Thank you very much indeed for joining us on a busy day. Mirko Bibic,
Thank you, Andrew.
The CEO of BCE, and BCE, of course, the owner of BNN Bloomberg. Up next.